And there you go. Now, this next topic is something I am super excited to get into, emerging markets, right? Obviously, in emerging markets, fiat currency doesn't work for most countries. In fact, especially in Africa, as we saw earlier, it's not a great store of value, and access to US dollars is very difficult. So, it is with no further ado, I would like to introduce Rahul to the stage and his panel to talk about emerging markets. Give him a big round of applause, everybody.
Hi, good afternoon, everyone. Great to be between you and lunch. Not the best, but thanks for the introduction anyways. I'm Rahul, 21 years in emerging, various things, payments, banking, and tech. And spent 8 years last with Swift and global payment strategy. Again, looking at how the world of legacy and the new can integrate, including stablecoins, should they get regulated. It's my pleasure here to speak about emerging markets and stablecoins, and I have a great panel. Maybe I'll just request each one of you to give a quick introduction, and then we kick off. Please, Charles.
Sure. I'm Charles Jansen. I work for S&P and the managing director focusing on digital assets. We made several products related to stablecoin. We've got a focus on risk assessment, but not only. We were the first to launch some crypto index also. I'll stop there.
Thank you, and thank you for having me here. It's lovely to be here. I'm sorry, I'm between you and lunch again. I'm Isha Varshney. I head ecosystem at Celo. Celo is a layer 1 blockchain, and I think the reason we're here is our focus from the beginning has been emerging markets. We have great presence across like Africa, Latin America, Southeast Asia. And I think the reason this is exciting to me personally is because I'm a product of emerging markets, having grown up in Asia as well as Africa. And at Celo Foundation, I think our focus, especially of late, has been becoming the home of stablecoin. We've kind of very early in the game, identified that stablecoins or payments is an excellent use case for Web3 in general, and have always kind of narrowed down on that. And so that's a little bit about me, and we can chat more.
Hi, nice to meet all of you guys on the panel. And my name is Ashok. I lead the blockchain practice for Mastercard in the APAC region.
Hi everyone, my name is Markus. I'm working on Mento Labs. Mento is a stablecoin platform on Celo, and we have a big focus on local currencies, so also non-dollar stablecoins. We have a West African franc, we just launched a Kenyan shilling, we just launched a Philippine peso, and a few other currencies, and are really excited about local currency use cases, and yeah, excited for this one here.
Thank you so much. And as you can see, it's a great panel, diverse thoughts. I have been warned there may be some punches thrown, so please watch out. Speaking about emerging payments, and I've recently opened my management consultancy in Singapore here, working a lot with some of the international agencies like World Bank and some of the central banks as well. And I hear a lot about, and over the last decade, been speaking to them about how regulated forms of money and new forms of money are evolving, and what that really entails. And this is classically a conversation in the spectrum of, at one end, the fiat world, right, account to account, and what's happening there in terms of innovation, regulation, which is, of course, much more mature. At the other end of the spectrum, you have, pure crypto, and most of the regulators are still trying to figure out what exactly to do there. At the same time, there's this gray space that has come across over the last few years, which is in the space of stablecoins. And I think I was talking to a few of the folks here earlier, there is an increasing acceptance in also the regulatory world, and of course, in the eyes and ears and usage of the consumer on using stablecoins at scale, especially so in the emerging markets. And when I was looking at some stats, recently, countries like Indonesia, for example, fastest growing year to year, 200% growth in the crypto usage, and then also in terms of value received, a figure of 157.1 billion was stated by one of the reports. So across other markets as well, there's obviously increased usage led by either the store of value argument on currency volatility, or looking at essentially speculative investments, or even looking at, the far end, as we've heard since morning about payments, both domestically and cross-border, and specifically depending on the currency, then that's, pegged against. So with that, I would say a question around where stable coins are being used, what are the opportunities, what are the challenges, and what exactly is it catalyzing in emerging markets. I now welcome some comments, from our panelists here. So, Isha, let me start with you, with a question around what is the current state of stablecoins adoption as for you in emerging markets, and what would be some of the key 1 or 2 benefits and risks associated with adoption of stablecoins in emerging markets?
So I'm going to just throw out some stats, right? Sure. When you look at like top 5 countries from crypto adoption point of view, it'll be surprising for you. I think like top is Nigeria, top 5 is emerging market, and there's like a clear reason for this, right? Most of these economies have domestic currencies or fiat currencies that actually depreciate in value rather drastically at any given point in time, right? So as a user or a retail person that doesn't get access to hedging solutions, what are your options? Like, if you use your net worth by 20% overnight, that's not, like, from an economic perspective, that's not great, right? I wouldn't want to do it. And it's not stuff that you and I kind of think about living in where we live in, or maybe Singapore, right? The reason emerging markets love stablecoin is their current banking rails, and I'm sorry, we have Mastercard on this panel, but the current banking rails, and it's not just, it's not Mastercard, but it's actually the banks don't allow them access to dollar-denominated fiat, right? You can't go into, like, I'm from Kenya, for instance. I can't go into Kenya and say, hey, I want to convert all my shilling to dollar to store the value, right? So what is my option, right? As a general retail user in these currencies, in these countries is like, well, I kind of need a way to hedge this currency. Stablecoins are the next best alternative. They're easy to use. You've got now some really great interfaces for stablecoins. Most of these users are like literally storing value with stablecoins. I'm going to give you a really funny example. I met somebody in Nigeria recently, and I asked them, what are you using this for, right? Is it just store of value? And he goes, Isha, you know what I can't do in Nigeria? I can't pay for Netflix. I can't pay for Spotify, right? And so we talk about all of these things like store of value, cross-border payments, but like there's like really simple things that people can't do in some of these countries, right? Because they're like, we're Nigerians, we're flagged at like high risk. I can't pay for Netflix and I can't pay for Spotify. I sometimes use like some of these dollar-denominated stablecoins to like pay for really simple services, stuff that you and I kind of take for granted, right? So I definitely see like stablecoins as like mass adoption across these currencies. Store of value, yes. Cross-border payments, absolutely. You get like what you just said something about Indonesia. Africa sees like triple-digit billion in a year moving in and out of the continent. So definitely for all of that, yes, but also for like simple stuff, right?
Fantastic. Netflix.
You can actually pay for Netflix if you use a credit card, but
not in Nigeria. Not in Nigeria, though.
Waiting for the punch there, Ashok. Go ahead.
No, I mean, I don't agree. I don't disagree with what Isha is saying, but my point is the fact that there's also, if you have a strong domestic network in the country, then stablecoins has obviously a less utility, right? But as those banking networks in these countries improve, with that, you can have traditional fiat rails and stablecoin rails, right? Because stablecoins offers a level of functionality that regular fiat rails don't. But I wouldn't completely discredit some of the existing networks.
Sure. Markus, any comments?
Yeah, and I mean, payments is a very good example. I would also call out remittances, sending money across border. Those of you who have listened to Mark this morning, he showed an example to send money from Europe to, I think, Malawi, and how expensive this is, and how stablecoins actually can improve the cost of remittances worldwide. On average, I think World Bank says the cost of remittances is around 6% or 7%, but especially emerging markets are on the much higher end of the scale. Sometimes there it's like 15-20% if you have to send money with like traditional rails. And then what I would also add, at Mento we are super excited about local currency stablecoins, and I would therefore add credit or access to loans in local currency to the use cases of stablecoins. If people in like Nigeria or in Kenya or wherever there is some inflation or higher inflation want to save, then of course they have a preference for a dollar stablecoin. But if they want to borrow and get a small loan for their business or for like any activity, they could if they have no access to banks, get that loan on-chain and get it in local currency. They would have a preference in local currency because if their revenues are in local currency, if they would only have access to a dollar, they're exposed to FX risk. If their local currency loses value, paying back that loan in dollar would become expensive, and therefore local currencies actually have a huge potential for local currency lending as well.
Great, great. And thanks for those comments. I think it's really evident, right, that in terms of the conversation, I would say that if I look at maybe 7 to 10 years back, there's a lot of talk about fragmentation and siloed choices, but more or less, today the conversation is more about coexistence and convergence. We've just spoken about business models, lending, for example, touching stablecoins. We've talked about, of course, cross-border payments and domestic payments as well, taking on various form factors in terms of money. Now, we would like to talk about growth, connectivity, and opportunity. So let me kick off with a question related to growth in emerging markets. And I raise a question on an important topic, financial inclusion. And maybe, Charles, to yourself, what is the scale of opportunity for stablecoins to promote financial inclusion in emerging markets? And what do you think about barriers, essentially, in that goal? And please share any of the personal experiences we were talking about earlier. Please go ahead.
Sure. So I've been living a long time in Latin America, so that's the use case I'm the most familiar with. And just to give you an idea of how it works there, so if you've been to any Bitcoin conference, they explain to you that people want to buy Bitcoin for remittances or that kind of thing. That's not at all what I've seen. Some example of the life in those countries. So if you want to buy a house or a condo in Argentina, it's going to be in dollar and it's going to be in cash. If you want to save, it's almost impossible to get normal access to the US dollar. Now, it's true for Argentina, it's true for many other countries in Latin America, including Venezuela. People want the US dollar. Right now, there's nothing else they want. They don't want the Chinese RMB. They don't want any other currency like the Russia one or a new BRICS country currency. So they have to go to the black market. The black market sounds weird like that. They call it cuevas, which mean a cave. So they go and they tell you, why don't you just go to a cave so you can use the black market? That sounds scary, but it's actually normal shops that are just everywhere. And just think that, so when I arrived in Argentina the first time, inflation was yearly 27%. When I left, it was yearly 200 something, 300. So every time you receive any type of money, it's specified, right, automatically through the financial system. And you would be able to bring it back into US dollar, I think, until 2012. So it was like a tax. And then they would just forbid you to get back the dollars, so you will have pesos, and you will have to go to the black market to change them. But if you want to buy a house, for instance, it means that you'll have to get your money out of the bank, assuming you're using a bank in peso. You'll have, or you just did a transfer, you'll have to bring it in a bag to go to the black market. You'll need to tell the banks that you're getting all this money out. You need to tell the black market that you will do such a big change. Of course, it's dangerous. People are not leaving US dollar in the bank because the bank have been taking everybody's money every 10 to 20 years. So what is interesting is that stablecoin technically solve a lot of that, especially for those big transactions. And before the DeFi summer, you would have maybe 1 to 2% of the black market that would give you access to stablecoin. Now it's between 1/3 and 50% of the black market that give you access to stablecoin. So usually it's going to be USDT, and it's going to be on Tron or on BSC. But that's really a good example of how, first, people want dollars, and the emergence and the development of stablecoin might have an impact, that's just my own opinion, on some countries that might actually lose their currency, because we see, for instance, in Argentina or even in Venezuela, etc., people will transact in dollar for houses, for cars, but they're not doing it for a smaller amount. And the main reason they're not doing it for a smaller amount is you can't. And if there was a way to actually do it, they might. So the emergence of stablecoin enable avoiding to carry that much money with you, and it also enabled to get a yield. Because if you're in Argentina and you got your dollars under your mattress, you are exposed to the inflation that now the devaluation of the dollar. It's still much better than the devaluation of the pesos, but and that's the issue here, you need to be a bit sophisticated and know how to use the different protocol, but they allow you to get a yield even on your dollars. Speaking of inclusion, that's something new. So as the wallet and the different system to interact with stablecoin will evolve, well, it's very likely that more and more people will get used to that, and I think it might impact some of the currency.
Great, thanks, Charles. And just extending the inclusion aspect, right, to beyond individuals, and if you look at SMEs, again, that's a segment which is clearly embraced stablecoins in various spaces, especially in the emerging markets. Gradually, there are cases where you see it's more even corporate size or high value usage as well that's occurring. But on this, let me get Markus in on his views, right? And the question, Markus, I have for you is, in terms of stablecoins being leveraged to support financing for SMEs, what were the opportunities, challenges, and the future in that space?
Yeah, and I mentioned lending and credit already as like a big use case for stablecoins. We just actually came back from a research trip in Kenya, and we've been experiencing how lending for SMEs, especially for very small businesses in Kenya, works. There's a big community element to credit there. There are these local lending circles called chamas, where basically a lending circle gets access to credit, and then basically inside the circle then distributes basically a loan to those who currently have need for a loan. And actually now we just launched this Kenyan shilling stablecoin there. There's first chamas across Kenya that now get actually a loan on chain because they don't have access to a bank, like local loan vendors, or maybe you can call them loan sharks, actually charge extremely high prices. And with stablecoins making like capital accessible, cheaper, there's actually huge potential for SMEs in frontier markets around the world. And therefore it's nice to see that this is already happening on chain. There are like different projects that, like different wallets, different on and off ramps, different like partners that support this. And therefore, I think like closing a credit gap that exists in emerging markets is a big potential for stablecoins.
Fantastic. And flipping back to the case of Isha was talking about earlier in terms of the currency volatility and the kind of push towards stablecoins being led there. In terms of the factors which are driving growth and whether it's really the inflation and currency volatility that's the main driver. Ashok, I'd love to have your views on this, especially, you've seen a lot of the Asian markets, especially both developed and developing. I would love to have your views on that space.
So, before I get into the question, just want to kind of touch upon where we kind of see this whole space, right? We continue to kind of maintain our traditional network, and we are a network. So we're pretty agnostic to what runs on our network. So a few years ago, we decided to actually use or let a number of US dollar-based stablecoins on our network. So you're able to transact on the Mastercard network using digital currencies, right? And then we also facilitate the way for you to off-ramp, because you may be able to move the money around pretty freely using stablecoins or any type of digital currency. But the pain point remains the fact that when you want to off-ramp it into fiat, it's not always that easy. So what we have done is we've kind of facilitated some of that off-ramping capabilities, which supports not only kind of consumer uses, even for SMEs as they're moving money around, if they're able to get funding or loans in stablecoins, their downstream suppliers and vendors may not accept stablecoins. So we facilitate that conversion so that way that fiat money can be really used and anywhere. Or if they're buying goods from cross-border, they're able to kind of purchase some of these goods using stablecoins, and then we're able to off-ramp them into local currency, right? So there's those type of pieces. On top of that, we're also in the process of building a brand new blockchain network, which allows you to tokenize your deposits. So it's like tokenizing bank deposits and move funds. It gives you all of the capabilities of a stablecoin or a digital currency, but without being one. So you're a regulated currency running on our network, right? So based on some of these across the 3 different areas that we're focused on, in Asia, in some of the emerging markets, they're able to use all of those to kind of use digital currencies. We definitely believe that digital currencies is the future. It's coming, or maybe actually it's here. And we want to facilitate that, and we want to make sure that the people who use our network are able to use it no matter what is the underlying asset in their wallet. Right? That continues to be our position. And the ability to kind of have cross-currency movement, you are able to kind of maintain a level of sovereignty within the country. You also have, I think you had mentioned the point about Latin America, where you see a lot of inflation. From the time that you want to really buy a house and you actually settle on that house, the value of the dollar may have increased. So how do you really counter some of those pieces? So we continue to kind of build some of these abilities where our partners can move funds much faster to mitigate some of those inflationary risks.
Great. And you also touched upon an area which is, I mean, I've seen it to be a classic, obstacle in terms of development of movement of money. And this is in terms of interoperability and connectivity, right? This is where the legacy needs to meet the new, and you need fungibility of money really in the real sense. There's a demand which is obviously existing today in terms of instant and 24/7 payments, no matter whether it's domestic or cross-border. Now, in that perspective, Isha, let me draw your thoughts on when you speak about this integration between either stablecoin networks themselves or with legacy payment infrastructure and systems. What are some of the pain points you see or continue to see, and what should be done as we move forward?
So I'm going to start this with an example. Me and Markus were just in Kenya. I did every single payment using a stablecoin. When I say every single payment, I bought all my coffee, all my meals, all my Ubers, everything using stablecoins, right? And it's because, and Kenya typically, for those that are unaware, does not run on, it runs on M-Pesa, which is mobile money, right? And so we literally had a builder there that went from, hey, we will connect and so how you pay on M-Pesa is essentially there's a pay bill number. So think of it like a point of sale systems or your credit tapping machines, right? So it's essentially a pay bill number. We have a builder in the ecosystem called Pratium that then converts any wallet address, whatever you have in your wallet, whether that's a shilling stablecoin or a dollar-denominated stablecoin, into M-Pesa really efficiently. It settles in 3 seconds. I made all payments in Kenya in stablecoin, right? And so that, in my mind, is where we kind of need to move to, right? But in the US, where I live in New York, can I do that? I don't know. Can you do that in New York? Can you pay for Uber?
We cannot do that in New York.
We can't do that in New York, right? And so I think emerging markets actually are really great testing grounds, right? I think there's a lot of innovation because there's also so much friction there, right? But also because people don't have legacy systems to overcome as much, right? So I think emerging markets are a great place to kind of start with some of this, where you see all of us kind of paid for everything in stablecoin, right? I couldn't do that anywhere else in the world. So I think with some of this, especially on and off ramping, is super critical, right? Absolutely, I think using my Mastercard card to on-ramp in the US and then kind of send it through to a wallet account to my mom, maybe in Nairobi, takes me 5 seconds, and the spread is, usually through banking rails, the spread is 22% is what I've seen. The spread is nothing. Yeah. My gas fee on Celo was $0.004. So.
I mean, you have a valid point. I mean, I think I made this point earlier, is that if you have a strong domestic payment network in the country, innovation is a little bit slow, right? I mean, if you look at Singapore, once you have Pay Now, what else can you do? You can do Pay Now within Singapore, to India, to Thailand. You can do a lot more than you could do in the past, right? So if you don't have that, then that's where you have stablecoin and other types of currencies kind of come into play, which need to fill the gap, because people still need to transact on a daily basis. I mean, Isha needs her coffee. So as a result, somehow you need to pay for that. So, and we want to continue to facilitate that, not only with just our network, but also what's happening around us.
And there was actually a lot of infrastructure missing in the past so that this would be enabled. And you've already mentioned that now there are more ways to actually off-ramp in like many different countries, easier with Mastercard, with other off-ramps and on-ramps. So this improved, but also like more infrastructure that is actually needed to have a very easy end user experience, like easy to use wallets, the ability, for example, on Celo, the ability to use your phone number as an identifier. If you want to send someone money on a blockchain, like in the past, it was always really, really complicated to send like to this hexadecimal address, and using your phone number as an identifier, for example, makes things much easier. Then also the feature that again on Celo you can pay for gas fees also in stablecoins. So users need in their wallet actually only stablecoin and nothing else, which also in the past was really complicated. If you had then a different currency for gas fees, this currency is volatile, was like just not a great end user experience. And I think here the infrastructure shifted so that now we can actually have these end user focused real use cases with like a good user experience.
Exactly, and as you're talking, I'm thinking about even CBDCs right now. In that space, there's obviously been a lot of work that's been put together by at one in the public sector, the other in the financial industry in general. But I was having this conversation a couple of weeks back, another conference, and the question raised was, what's the real driver for CBDCs to go live in some of these markets? There are very few, right? There are literally a handful of markets where CBDCs are actually live. And Bahamas happen to be one of the examples, right, where it's live and people are trying to understand what's the driver, because they do have existing payment systems and they do have similar telecom-based services, etc. But it was very interesting. The final outcome of that discussion was that in Bahamas there's so many islands that it's costly to move cash. So and literally 90% of the room did not know that. That was the driver for CBDC's adoption in Bahamas. So, I continue to draw the analogy that there are obviously multiple drivers, right, behind stablecoin acceptance and the domestic and cross-border sense. One of the other questions I have on Kenya, for example, right, with M-Pesa obviously has been a legacy, highly inclusive, kind of a platform. How would stablecoins actually, measure out against something like M-Pesa being already available? And is it the fungibility of money or access or something else that's actually driving that kind of a shift? Isha? Or?
Yeah, I can go first and Markus can join. But like M-Pesa is technically shilling denominated, right? So the problem with the M-Pesa is it's literally 1:1 with the shilling. And so yeah, as like a medium of transfer and ease of usage, as infrastructure, it's great. It's also ubiquitous with money in Kenya. Like when I say people just transact in M-Pesa, they just transact in M-Pesa. But I mean, the fact is that the shilling, I mean, I think in the last, I don't know, the shilling was at like, I was in Kenya in February, the shilling was at $160, $170, as opposed to like maybe last year, September, it was at $100, right? So the shilling does lose value very, very quickly. And so the M-Pesa has essentially the same problem as the shilling, right? Whereas if you are able to store value in a dollar-denominated currency, you don't lose the value of your net worth.
Currency volatility.
It's currency volatility at the end of the game.
Markus?
And additionally, also M-Pesa is expensive. It's especially expensive when you want to send money across borders. It also most often doesn't work for remittances because M-Pesa is super strong in Kenya, but not so strong in many other African countries. Then there's also, you have to have a Safaricom SIM card. It doesn't work with others. And then the rest of mobile money in Kenya, that space is really, really fragmented, and it's like all non-interoperable technology. And when we're building like for stablecoins and building open source, now we actually build something that works across borders, across networks, across currencies, and therefore you don't have these problems.
Yeah, the other piece for Kenya specifically is that Kenya, 60% of your economy runs on tourism, right? And as a tourist, you can't get M-Pesa because you go to Safaricom, you get a Safaricom SIM, and then you have to take out cash. I can't use my bank account to like charge my M-Pesa account, right? All of this friction goes away. We have something called the MiniPay wallet. You can just download the MiniPay wallet with your credit card Mastercard credit card, with your credit card, literally keep like a dollar or shilling denominated stablecoin with Pretium, you can then off-ramp into any of the merchants, right? You can do anything there. So stablecoins make it so much easier. It's like 3 clicks as opposed to going to a Safaricom shop, showing your passport, getting cash. It's
So, this brings you back to the convergence comment I'd made earlier, right? So there's obviously a lot of convergence happening within the financial ecosystem to make multiple, forms of digital money accessible and available, right? Now, one of the other kind of driving and transforming facts for emerging markets has been the use of digital wallets, right? So a good example in Kenya, but in general, right? Wallets which are integrating normal fiat options as well as cards, as well as crypto options, etc. All kinds of assets. So, the question I had was in terms of the digital wallet adoption, right? Is that also one of the main drivers? And it's supporting. I mean, there's obviously friction involved in such integrations. There's cost involved. Is it actually supporting, the actual adoption? And is that an opportunity to do more, perhaps, or is that a challenge? Ashok?
Thanks. So, I think the digital wallet is great, right? I really appreciate it, considering the fact that we think of it as a way for many things. You can hold, obviously, fiat currency, digital currency, your card, and we even go, because at the end of the day, we want to enable payments in a simplest form. And it could be anything. It could be your reading habits, your data that you're willing to kind of use as a currency for payment, right? And a digital wallet allows you to store all of these values. So as long as you can tokenize it and stick it in there, you can use it to spend, and you could use it for interchange. It could be information that you're passing from one to the other, just to claim who you are. So at the end of the day, payments has got a couple of different layers, right? It's not just about moving money. It's also about moving information, because you want to know who's paying you and who you're paying. So a lot of people forget that when you do a retail transaction, like, okay, I bought a cup of coffee. I don't really care who the merchant was. But you really want to know when you're making maybe an SME payment or a B2B payment, who that counterparty is. So as a part of that, the digital wallet is kind of the core to store all of this data and exchange this information. And I think the adoption is really going to grow as it becomes easy for people to get a digital wallet.
So thanks a lot for that. I think we've spoken a bit about the growth drivers. We've spoken a bit about connectivity. And now talking about opportunity. I think one of the spaces which keeps coming around is the balance, the right balance between regulation and innovation. Right? There's a lot of innovation definitely out there. The question often comes around to is regulation necessary in all aspects for stablecoins to thrive and survive, or is there some kind of a hybrid balance that's needed in the interim while we kind of figure out what the details. Maybe a quick question to the audience here, right? Just a show of hands. Is regulation necessary for the success of stablecoins? Regulation is regulation. You never know it's good or bad until it comes, but it should be good, right? So I see literally 5 hands in the room. So this is a very interesting aspect, right? When you think about how regulation is being treated. You have the MiCA, Act coming on in Europe. There are various forms of discussions in the region as well. But I would love to have your views on this balance, innovation versus what role perhaps, what support a regulator could provide as well to the ongoing work. Who would like to take this, Markus?
So I think especially when it comes to working with large institutions that open up liquidity in the space, and you can see here in this panel, there are large institutions part of this panel, regulation is necessary, otherwise we cannot work with Mastercard or S&P or these institutions. We have as a partner several mobile carriers as well. For them it's really important that regulation is there so that they have certainty that they can actually operate in this space. There won't be a global regulation, so you can, for example, with MiCA, it is regulation that is specific for stablecoins for Europe, the markets and crypto asset regulation. And then being compliant with MiCA already helps us to then actually partner globally with other institutions, because then we can always point to Europe and say we are compliant there. If there's regulation specifically on stablecoins in Kenya, we will be compliant with that as well. It currently there's not, but we can show that we are compliant with MiCA regulation. Therefore, it's helping us.
Charles, would you like to add some comments?
So I'm a crypto native, so maybe I started thinking it was not that necessary, but as you really interact with, well, regulator, but institution in general, you need regulation. I think the best example is always to take the example of the internet. For instance, for big banks or just big financial market participants to be using stablecoin or just blockchain in general, they need some rule of the game or they cannot play, right? There's a lot of banks that are not touching Ethereum or whatever else because they cannot even pay the gas fee, right? So you need some definition of what can be done, at least as a start. Now, I won't mention one regulation or another, but some regulations that are being set up or were set up are, in my opinion, and opinion are my own, too restrictive. And I believe that you'll need incremental regulation, but you also need to be able to let the field breathe, like it was done with the internet. And as things get bigger and bigger, then you'll see what really needs some regulation. So you need the initial one to enable players to participate and know what can be done and what cannot be done. But then don't create something ideally too restrictive that some regulation did that forbid an amount of transaction a day or that kind of thing.
Isha?
I actually want to add to some of this. I think I don't have a view whether regulation is good or bad, right? I think, at least my experience has been some emerging markets, the regulators are actually really excited to work with the stablecoin providers to figure out what is optimal regulation, right? A bunch of regulators have set up sandboxes, have active conversations with stablecoin providers, networks such as ourselves, to figure out like, yeah, we don't know so much about this. We'd love to learn. And so like, I think there's also like, when we think about regulators, we think about the larger regulators. Some of these countries are actually doing a really good job in educating themselves and also getting like feedback from the industry to say, how do we regulate this? Because we don't understand this.
The AMAS is a good example with Project Guardian.
Yeah.
Yeah, I mean, I remember the conversations that kicked off post, Libra, and I get a similar sense now where a lot of the regulators globally, as you said, are trying to first of all understand, assimilate, and there's a lot of work under the BIS, the G20, and the various central banking forums, looking at exactly how to understand and solve, for this ecosystem. So, Ashok, you want to add something to that?
Yeah, I mean, so I know everybody says, regulation stunts innovation, right? But I don't completely agree, because when you start losing money, then you say, why, shit, it shouldn't be regulated. So you have to kind of find a balance. And to Isha's point, the regulators are really trying to learn some of these things, right? And you have really strong regulators which are saying, well, this can really change how we really make the future rules. And it's up to people like large corporations to really drive some of these regulations, not just for profitable purposes, but also to kind of get the reach. Because if you get more people using these services, it drives volume, it drives innovation, it drives utility, right? Then it becomes a day-to-day operation. So regulation can really kind of drive some of these things, but you have to find balance to make sure that it's not really stunting innovation.
And well, not to be too provocative, but there was a conversation earlier today over coffee where I was just sharing that if you have $2 going to terrorism financing through any means, everybody in that chain gets questioned and pulled in. There's no running away from it, right? So, anyways, with that thought in mind, right? My last question to the panel is, what would be that one call to action, right? The one thing that has to be done to ensure that stablecoins succeed and get adopted at scale in emerging markets? Starting at that end. Markus, over to you.
So I'm super excited about local currencies, as I mentioned earlier, and local currency stablecoins as a way to unlock credit on chain and therefore close the credit gap. So I think my call to action would be if you're building, build infrastructure for this to make it really accessible. So no matter if you're building ramps or infrastructure for this network, if you actually make stablecoins accessible, cheaper, then I think this is a good thing.
I mean, I think this consolidation, right? There's lots of stablecoins out there, all doing the same thing, and majority of them are US dollar based or euro based, some of the bigger major currencies. And to Markus's point, if we can get domestic currency stablecoins, I think that will definitely increase adoption. So, if there could be more stablecoins in local currency, which could move domestic money and have the ability to do cross-border, I think that will really set the pace for the future.
I think I agree with what both of you have said.
Where are the punches?
I know, right? I have to defend myself. I think my call to action would be stablecoins are used very differently across. We've kind of clubbed everything together as emerging markets. Stablecoins are used very differently, even within a region, right? So what you would use stablecoins for in Latin America is not what you'd use stablecoin for. The use cases aren't the same. I would love for builders here in the room and just generally in Web3 to go on the ground and do research as to like what is the use case for stablecoins, and then build accordingly. We have this really great tendency, and I think it comes from a good place, but we try to force fit solutions to problems that sometimes don't exist, right? And similarly with stablecoins, right? Go on the ground, do the research, see what the stablecoin use cases are, and then build accordingly, but build a really great product. I'm going to give an example of Opera Mini Pay. Some of the Opera team is here. I would love for all of you to check out. I mean, it's currently only available in Africa, in 7 countries across Africa. It's a stablecoin only wallet. It is dollar denominated. The UI, UX of the product, it is spectacular. It is like a fintech product. My mom, and I'm not kidding, my 85-year-old grandmom is able to function with that product, right? I can send her like $5 from New York to Kenya, and if she can manage that, that's what we need, right? For like broad scale adoption of stablecoin across the world, we kind of need to think about like, hey, yeah, what is the use case? How do we make it really good so everybody understands it? And then keep it simple. It's called Opera Mini Pay. It's a really clean UI UX. It's only stablecoin based, and the team did a really good job of like actually going to each country. They're across 7 countries and they're kind of expanding across Africa, and then kind of will move on to the rest of the world too. But I think what I really appreciate about this team is they're a great product team. Their feedback loop is really quick. They kind of iterate really quickly, and each country they've gone in on the ground and figured out like, okay, for this country, this is the use case we need to target. Right? For some countries like Kenya, for instance, they do like savings, but for other countries they do other stuff which that country requires. And then it works on the ground. Some of this stuff doesn't work on the ground. When you want to do a payment, it doesn't work. Whereas with MiniPay, the product works. So yeah.
Charles?
So I got a slightly different view. So I think the use case of lending in your own currency is something that most will want for sure. Then for all those kind of lending, there's a need for more infrastructure and having an idea of the risk for those that would provide the money. But personally, maybe it's because my view is really on Latin America, I think stablecoin, and again, it might be a very different opinion, I think stablecoin as they are right now, and probably as they will stay, are a tool for mass domination of the US dollar. And I think that there are many countries in the world, not that much in Europe, not that much maybe in North America, that if you let, through the technology, the population get direct access to the US dollar, they will prefer that over the country currency. That's true for every country that have a very long history of devaluation. And I think that's one of the biggest impact that stablecoin will have for retail, etc. So some country might fight this for sure because they don't want to lose their own currency. Some might actually welcome it, like Argentina right now. They're looking maybe at dollarizing again. But yeah, I don't really have a call to action. But I think the impact will be tremendous. And it will have, because there's one more angle we didn't touch on, is all the stablecoin are usually buying US treasuries. And that's something else that will be extremely interesting, as you'll have the stablecoin becoming increasingly the biggest owner of treasuries. So that's for another debate.
Interesting. Great. So we've seen obviously that there's a fragmented ecosystem. There's actually a problem of choice today, and great choice. So there are a lot of innovative use cases. There's a lot of work going towards actually balancing innovation with regulation and with what's consumer demand. So I'm quite positive as well. I think the future of stablecoins in emerging markets will continue to shine, and hopefully the balance actually sets it for the longer term for success. So thanks a lot, and hope you enjoyed the conversation. Thank you.
What an excellently moderated panel by Rahul. Let's give him another round of applause, everybody. That was great. I think there are a couple of really interesting points that were made there, specifically at the end about how most stablecoins are collateralized by U.S. Treasury bills. What happens in the world where increasing politicization of the paying back of the debt of those Treasury bills defaults? And what happens if, let's say, the value of the US dollar crashes because the government decides not to pay back that debt for US Treasury bills? So we'll wait and see. Also, another fun fact is the majority of stablecoins, as you know, are US dollar denominated. And I am very excited to see over the next decade what percentage of stablecoins that are issued will be denominated in local currencies.